So that brings us to the last presentation of the webinar this morning, and that is with one of our global equity managers, Dodge & Cox. The person who we will be speaking to is Bryan Cameron, who is Senior Vice President and Head of Research at Dodge & Cox. Now, he is based and lives in California in the United States. So given that it's the early hours of the morning, we actually had our interview with him at Friday last week. So we will be just showing you our discussion. And really, the discussion is all around the future scenario of, are we looking at a rotation out of the last 3, 4, 5 years where we've really seen the quality, consistent compounders, large cap equities running hard, and value as a style underperforming. But more recently, over the last 3 months or so, value, the more cyclical type of stocks, have been coming through quite strongly. And we really were asking Bryan, does he see this as the beginning of a rotation from quality into value? So we're going to play you the interview. It's about 15, 16 minutes long, and then we will wrap up at the end of that.
Well, thank you for that kind introduction, and more broadly to Net Group for inviting us to participate in your webinar and for your confidence in our firm. First, just a few foundational characteristics of Dodge & Cox. I think we're known for placing a high priority on research on individual companies or stocks. That really is our key priority. Second, we take a long-term time horizon, which we define as 3 to 5 years for any investment we make or an outlook on an entire market, which we'll probably be speaking to mostly today. And then finally, we lean strongly, as Trevor mentioned, towards value style investing. So my comment should be in the context of our overall philosophy or the framework by which we make investment decisions. The question posed to us today, is it time to rotate from global so-called quality stocks to global cyclical stocks? And for the purposes of this discussion, I've taken a little bit of license to make quality or growth comparable. They're not total overlap, I think, in terms of the way that people use those terms, but in today's world, they're pretty close. And then in unison with that, using the word cyclical and value to be somewhat comparable. The key point from our standpoint is our belief that we are in the midst of a large rotation within the global equity markets, which could be categorized as either moving from quality to cyclicals or from growth to value. Again, we would pretty much equate those two segmentations of the market. If we can move to slide 4, I believe, in your packet, that's the one. The first thing to understand is the setup for the rotation. And here we're going back at least 3.5 years. We're in the lower right portion of this slide. We see the strong outperformance of growth over value during this time frame. The upper left is a valuation measurement, which is also indicative of the expansion of valuation metrics within the growth sector, which is the darker of the two lines relative to the value sector. So why did this happen? First, there's a period of exceptionally low interest rates around the world, which had impacts on entire markets, and within markets, we would argue favoring the growth areas or the quality or compounder areas, in large part disadvantaging certain parts of the value sector, most obviously finance. Second, and here we'll move to the next slide, would be the dominance of high technology, and particularly the so-called FANG group. This is a U.S. measurement where obviously all the FANG companies are, but of the S&P 500 returns, they were dominated by just 5 companies, the top 5, which are listed in the footnote, probably too small to read, but Amazon, Apple, Facebook, Google, or Alphabet, and Microsoft. Those are the 5 companies which really dominated performance within the U.S. market, which obviously is an important component of the global universe. And then the third point was in terms of why this has all happened in retrospect, would be the exogenous shock of COVID, which was an exclamation point on this growth versus value dynamic within world markets. I don't have a slide to show the impact of COVID, but clearly it divided the equity markets into winners and losers. And these are US numbers again through the third quarter of 2020. So the first 9 months of 2020, the leading S&P sectors were information technology up 29%, consumer discretionary up 23%, and communication services up 9%. That's all relative to the S&P 500 being up 6%. In contrast, the losers were energy down 48%, financials down 20%, and industrials down 4% during that time frame. So what was critical after all this happened was how you were positioned. If you can go to the next slide. Clearly, this 3.5-year period, and particularly the last year or the first 9 months of 2020, were not a lot of fun for value managers, as I'm sure you can appreciate, or for the clients that held the value-oriented portfolio such as ours. But one thing we were confident in is how one should be positioned given the market conditions. This again is US markets, but it divides the US market into what we were calling COVID defensive stocks versus COVID cyclical stocks. The definitions are down there just below the bar graph, but COVID defensive stocks were those companies that either were not impacted much financially or even advantaged by the stay-at-home sort of environment we've been dealing with around the world for the last year. Stocks which have been strong outperformers, and the valuations were at significant premiums. The COVID defensive were dominated by technology sectors, healthcare, and consumer sectors. The COVID cyclical area, conversely, had significant impacts to their business. The stocks were severe laggards, as the data I just went through indicated, and the valuations quite depressed. Here, financials, energy, industrials dominated that group. This is how we were positioned. This is our US stock fund, not the global fund. But the S&P 500, the metric we'd be measured against in the US, was 70% COVID defensive and 30% COVID cyclical. By the end of the year, the Russell value about 50-50, and our portfolio is under 40% in COVID defensive and over 60% in COVID cyclical. So we had very strong conviction that the place to be in this market was in the laggards, the depressed valuations, which included financials, energy, industrials, among other groups. If we can move to the next slide. What's now happened in retrospect is a reversal of fortunes, and this began in the fourth quarter of 2020. And really, we can almost pinpoint the date to November 9th, when effective vaccines were announced by Pfizer, and then a week later by Moderna. Here you can see, beginning in the fourth quarter, value starting to outperform growth. You see that in the upper left, the data there. And then the fourth quarter returns are in the lower left, and you see the reversal of fortunes within markets. So what was leading, these are global numbers, but the financial area, energy, industrials, materials were the leaders. Technology were not the laggards. They were sort of in the middle and treading water, if you will, relative to indexes. And then the laggards have been defensive areas, consumer staples, healthcare, utilities, et cetera. So pretty much a total reversal of fortunes here, where the leaders become the laggards and the laggards became the leaders. What have been the catalyst for this change? The backdrop on this is really that the valuation gaps between the growth area and the value area are still quite large. And what has happened is mostly, and what we expect to continue to happen, is that the bottom of the market, so-called bottom defined by valuations and levels of expectations, but specifically finance, energy, industrials, have risen. And here the keys have been the vaccines leading to a healthcare recovery, leading to an anticipated full economic recovery. Along with this, there became the chance for higher interest rates, which we are starting to see. Many people did not expect this given central bank policies around the world. But in the US, the 10-year Treasury has already risen from 0.5% at the bottom last summer to in the neighborhood of 1.6% today. And just from year end, 2.5 months, it's risen from 0.9 to, again, that 1.6 number. So this obviously helps certain sectors that are in the value camp, including finance. It tends to also hurt that high growth area, and I may expound on that a little bit more. There was also an opportunity with a full economic recovery for the chance for higher oil prices, and this has also happened as oil prices risen from about $20 a barrel to about $65 a barrel. The other part of the argument, which is only starting to happen, is that the top of the market could very well falter. This has just started to happen in the last month or so. We're starting from very high valuations. These are some valuations that were written about in Barron's magazine on February 19th, but they wrote an article. This is the price to sales for certain select high-tech companies, not price to earnings, price to sales. Lemonade 82 times, Snowflake 78 times, Shopify 44 times, Cloudflare 43 times, Zoom 36 times sales. In the history of financial markets, these would be extremely high valuations and at risk to anything going wrong with their particular situation. So very high valuations. We think, again, higher interest rates not likely to knock some of the froth off of valuation metrics for high growth stocks. If you have an interest in that, we can go into that more in the Q&A. And then we think there are specific challenges for many high-tech stocks which aren't fully appreciated, specifically market saturation, competition, technological change, and a change in the legal and regulatory environment that they face. One caveat to all this is it's not necessarily as simple as growth versus value or quality versus cyclical. For example, we are overweight in pharmaceutical stocks. If you go to the next page, there's a slide on that where we are actually quite interested in many pharmaceutical stocks because of the level of innovation, the exposure to emerging markets, strong earnings and free cash flow, and then reasonable valuation metrics with many of the stocks selling in the mid-teens PE ratio. So far, and in conclusion, in 2021, markets have continued to move strongly from value to growth, or where value, is dominating growth. The magnitude of this outperformance in favor of value for the first quarter of 2021 is at least as big or greater than the fourth quarter of 2020. So combined the last 4.5 months, there's been quite a move in the markets with a sudden and dramatic move in favor of the value-oriented stocks and away from the growth-oriented stocks. Certainly, there's no guarantees about where we go from here, but we would anticipate the conditions are still quite good for this trend to continue, and hence our conclusion that we are in the midst of a significant shift within or rotation within the markets from quality to cyclicals or from growth to value, if you will. So I'm going to conclude my remarks there and leave some time for questions.
Great, Bryan. Thank you so much for that. And thanks also for keeping to the agreed time. So I will ask you a few questions. The one area that we often get asked about here in South Africa, and of course we're an emerging market, is what are our views of emerging markets going forward relative to developed markets. Now, Dodge & Cox, in your fund, you only are invested into, or you only invest into stocks that are listed on developed market exchanges. But I know that you've always had a liking or a bias recently towards companies that have the majority of their earnings coming from emerging markets. Is that still the case within the portfolio? And would you see that being advantageous going forward if the economy turns around and we get stronger growth coming from emerging market economies?
Right. An excellent question, particularly for those that own a global fund. And we've long had an interest in researching and investing in select emerging market companies, as well as you say, benefiting from those companies that have significant opportunities to generate revenues and earnings from growing emerging market economies. So it's long been of interest of ours. We, like we do with everything, view it on an individual company by company basis. The emerging market representation in our funds is significant, whether measured by direct investment in emerging markets or as a byproduct of being a meaningful component of developed companies' revenues. Today, I think the question implies, given changing economic circumstances, isn't this a good place to invest? I think we would agree with that assessment if that was the only variable, in the sense that we think emerging markets are often the tail at the end of the whip, if you will, in terms of benefiting more in a growing global economy and perhaps suffering more in a recessionary or problematic global economy such as we had in 2020. But not all markets are created equal, and economic growth is not the only variable. I think we also consider all the other potential factors for an individual company or an industry or a country when making an investment decision, and certainly valuation is important. And you will find certain emerging market countries today where valuations seem rather high, and other markets and specific companies where valuations are somewhere between reasonable and depressed. And I think for us, that's where you'd find us for the most part investing. Though you will see in our portfolio certain Chinese internet-related stocks. So there we've made investments over time at opportune periods where perhaps the growth expectations weren't as high as they are at different points in time.
Great. Bryan, so leading also on from that, and you did mention it in your presentation, and of course it's the hot topic, these FANG stocks, etc. So if I look at your one slide in terms of the IT sector within the Dodge portfolio, you have been, as you mentioned, underweight the defensive COVID stocks. You do hold Apple, but underweight. I haven't been holding Microsoft recently, but specifically you are overweight what you call the COVID cyclical stocks. Could you give us an example of one or two stocks in that IT sector that you would classify as COVID cyclicals, and just sort of the main thesis behind those holdings?
Sure, would be happy to. And it's really indicative of a large portion of market cap within technology is quite expensive. And the FANG stocks really dominate that group. And at one point, there were just 5 or 6 companies in U.S. markets that accounted for a quarter, 25% of the entire market. So in terms of market cap, much of the market cap would be on the high expectation or somewhat expensive side. And as you mentioned, we selectively own a couple of the names in that group, bought at much lower prices, but collectively, we are well underweight, as you indicate, that expensive or higher valuation parts of technology. But conversely, as you indicate, we're overweight some others. And this really tends to be the hardware portion of technology where growth has been and expected to be much slower. A couple stocks that stick out would be HP Inc. This is a long-term holding of ours, but the company sells PCs and printers. The valuation has long been depressed because of perceived growth metrics, and frankly, the company perhaps under-earning in some respects. I think we were attracted not only to the very, very low valuation and expectations, selling for 10 times earnings or less during many parts of the last several years, but also the opportunity for improvement. I think a catalyst for change happened to come just before COVID, when Xerox was making an unsolicited takeover offer for HP Inc. The company HP managed to thwart that takeover, but in so doing, I think made a renewed commitment to cost cutting and returning a fair amount of cash flow, which is ample at the company to shareholders. So in spite of lack of growth, we saw certain attributes and the potential for improvement there combined with a low valuation. And subsequent, HP Inc. has been doing quite well here in this recovery period. Another I might cite is Cisco. Cisco has some higher valuation metrics in terms of price to sales, but not on price to earnings. This is a company that's also been impacted by COVID, selling in some part hardware type of systems to Fortune 500 companies in a work from home environment that is not done nearly as well in a business sense. But the company has tremendous free cash flow, a wonderful balance sheet, and really it's a combination of the low expectations there with an opportunity for improvement, both due to economic variables improving here, as well as their own so-called self-help measurements, including cost cutting. So those are only a couple examples, but I think our interest there in technology currently is in the more depressed hardware-oriented portions of that particular sector. But I might add, if valuation metrics change a lot, we have nothing against owning anything in technology if the combination of our long-term outlook and the valuation is right.
Thanks, Bryan. I'm going to put you on the spot. We've just got 30 seconds or so left. You again mentioned it in your presentation, the Fed and interest rates. They have indicated they intend to keep it lower for longer. You mentioned that yields have increased from 0.9 to 1.6 on the US 10-year, for example. When do you and your team roughly think that the first Fed interest rate hike might come? I know you're not forecasters, but what would your best guess be?
You really have to, great question, but you really have to segment between what the market's doing and what the Fed is doing, or central bankers around the world. We think central bankers do have a lot of control over short-term rates, but historically not so much over intermediate or longer-term rates. We think markets determine those. And the best evidence recently here is that move in the 10-year and longer maturity in spite of Fed intentions to keep interest rates lower for longer. So ultimately, markets will determine these things, and we think markets are responding to the prospect for much stronger economic growth and perhaps the prospect of higher inflation. The Fed in the US says they likely not to move on interest rates until inflation is somewhat over 2% for a period of time. So if you want to just take the inflation metric, many people are starting to be concerned that we might get there sooner than later. But our major point would be we're not waiting, or markets or investors shouldn't be waiting for what the Fed is doing, but rather, have a framework that certainly includes market ability to set intermediate and longer term rates. And we think that's the bigger part of the picture rather than Fed intentions at this point.
Great. Well, that was our discussion with Bryan on global value versus quality compounders, and hope you found that interesting.